That's the real head-scratcher, isn't it? The Fed's been cutting interest rates all year.
Right.
3 times, to be exact, trying to, rev up the economy.
Yeah.
But mortgage rates are, like, stuck in the mud.
Yeah.
It's like they're completely ignoring the Fed's moves.
Yeah.
That's what we're going to unpack today. You've given us a collection of articles about this latest December rate cut and its potential ripple effects on mortgages, and we're going to help you navigate this complex terrain.
It's a common misconception that the Fed has a direct line to mortgage rates, but the reality is much more intricate. We'll unravel how the Fed's actions intertwine with the bigger economic picture and what that means for your borrowing power.
All right, so let's start with the December rate cut itself.
Okay.
The Fed shaved off another 1/4 percentage point, bringing the target range down to 4.25% to 4.5%. This is the third cut we've seen this year, but I'm guessing it's not as straightforward as rate cut equals lower mortgage rates.
Right. While it does nudge things in that direction, it's crucial to understand this was a fairly modest adjustment.
Okay.
Especially when compared to the 0.5 percentage point drop back in September.
Yeah.
These smaller cuts tend to have a less pronounced and immediate impact on what you'll see from lenders.
So no dramatic plunge in mortgage rates like we saw after that September announcement.
Probably not. Remember, mortgage rates aren't solely dictated by the Fed. Lenders have a whole algorithm they use to assess risk and set rates, factoring in things like inflation, unemployment numbers, and perhaps most importantly, the yield on 10-year Treasury bonds.
Hold on. Why are 10-year Treasury bonds so important in this equation?
Well, for lenders, the 10-year Treasury yield acts as a kind of benchmark for long-term lending risk. When investors buy these bonds, they're essentially loaning money to the government for a decade. The yield represents the return they expect for taking on that risk.
Okay, I see the connection now. Lenders see mortgages as a similar type of long-term loan, so they look to those Treasury yields as an indicator of what kind of return they should expect for the risk they're taking.
Exactly. Think of it like this. If investors are demanding a higher yield on those 10-year Treasury bonds because they're worried about the economy's future,
Right.
lenders will likely raise mortgage rates too to make sure they're compensated for that perceived increased risk.
That makes sense.
Yeah.
It's all about lenders balancing risk and reward, and those Treasury yields give them a reference point. But if that's the case, why didn't mortgage rates fall in line with the recent rate cut?
Well, sometimes, even if the Fed makes a move,
Yeah.
the market might have already anticipated it. Remember, lenders are constantly monitoring economic data and Fed pronouncements. They're like seasoned poker players trying to read the tells and predict the next move.
So they might adjust their mortgage rates before the Fed officially makes a move to reflect their expectations.
Precisely. And in this case, many lenders had already factored the December rate cut into their mortgage offerings based on all the economic signals and hints the Fed was giving off.
Yeah.
By the time the actual announcement rolled around,
Yeah.
the element of surprise was gone and the impact on mortgage rates was muted.
But even though the Fed cut rates, lenders essentially shrugged and said, we already figured that was coming.
Pretty much. And there's another interesting twist to this story that unfolded right after the Fed announcement. The Dow Jones Industrial Average took a nosedive, plummeting over 1,100 points. It was the 10th straight day of losses, marking the longest losing streak since 1974.
Wow, that's a pretty dramatic reaction.
Yeah.
What sent investors running for the hills? Was it just the rate cut itself?
It was more about what the Fed's move and their accompanying statements signaled about the future. They indicated that they only anticipate 2 rate cuts in 2025, which is fewer than many had hoped for. This sparked concerns about the economy's long-term health, prompting a wave of selling as investors reevaluated their outlook.
So it wasn't just the rate cut itself, but also the Fed's subtle hints about the road ahead that spooked investors. It's all interconnected, and those reactions in the stock market can have a ripple effect on things like lender confidence,
Right.
which, as we've discussed, can ultimately influence mortgage rates.
Exactly. It's like a chain reaction, where even a seemingly small action from the Fed can trigger a series of events with far-reaching consequences.
It seems like trying to predict mortgage rates is about as easy as predicting the weather, maybe even harder.
Well, there is another key piece of this economic puzzle we haven't touched on yet.
Okay.
Inflation. Inflation cooled for much of the year,
Right.
which is generally good news, but it's become a bit more stubborn lately, even creeping up slightly in recent reports.
That's right. I remember reading a quote from Fed Chair Jerome Powell where he acknowledged this, saying, inflation has once again underperformed relative to expectations. So how does this sticky inflation factor into the Fed's decisions and the trajectory of mortgage rates?
Well, this persistence of inflation is a major reason why the Fed is hesitant to make more aggressive rate cuts. They're walking a tightrope,
Right.
trying to find that sweet spot where they can stimulate the economy without letting inflation run wild.
Yeah.
And it's also a key factor keeping mortgage rates from falling more significantly.
So it's not just about whether the Fed cuts rates, it's about how much they cut
Right.
and how those cuts are perceived in the context of inflation and other economic indicators.
Exactly. It's a complex interplay of forces, and lenders are trying to make sense of it all just like the rest of us.
And speaking of trying to make sense of it all, let's go back to that surprising tidbit about mortgage rates actually going up in October, even though there wasn't even a Fed meeting that month. That really underscores how much influence those other economic forces can have on rates, independent of what the Fed does.
It definitely does. It's a stark reminder that the Fed doesn't operate in a bubble. There are all these other currents and undertows in the market that can impact mortgage rates, and sometimes those forces can override the Fed's influence entirely.
It's like trying to steer a boat through a storm. You have a destination in mind, but you also have to constantly adjust your course to account for the wind, the waves, and the currents.
That's a great analogy. And that's why it's crucial to stay informed, be adaptable, and consult with experts who can help you navigate these choppy financial waters. It's all about staying flexible and informed in this environment.
So what's the bottom line for those of us trying to make sense of this mortgage maze?
I think the most important thing is to focus on your individual financial goals and circumstances. Don't get caught up in the hype or panic about every little move the Fed makes. Instead, take a step back, assess your own situation, keep an eye on market conditions, and be ready to act when you spot opportunities that align with your needs.
That's solid advice. It's so easy to get swept up in all the headlines and lose sight of your own financial compass.
Speaking of making sense of things, can we go back to that connection between mortgage rates and the 10-year Treasury yield? I'm still a little fuzzy on why those two are so closely linked.
Of course. It all boils down to how lenders evaluate risk when setting their rates. When someone buys a 10-year Treasury bond, they're essentially lending money to the government for a fixed period, and the yield on that bond reflects the return they expect given the perceived level of risk.
Okay, so the higher the yield on those bonds, the riskier investors perceive it to be to lend to the government. But how does that translate to mortgages for everyday people?
Well, lenders view mortgages as carrying a similar level of risk as those 10-year Treasury bonds. Both involve lending money for a relatively long time frame. So if the yield on Treasury bonds rises, signaling higher perceived risk, lenders will typically raise mortgage rates in parallel to maintain a comparable return for the risk they're taking on. That makes sense. It's like a balancing act for lenders, making sure they're being compensated for the level of risk involved, and those Treasury yields provide a helpful benchmark for them.
Precisely.
Now, I noticed that Chair Powell seemed to really emphasize the fact that the U.S. economy is still growing, despite all the whispers of a potential slowdown.
Yes, he reiterated that point several times during his press conference, even stating that the economy's resilience was a key factor in their decision to forecast fewer rate cuts next year.
So it sounds like the Fed is cautiously optimistic, but also keeping a wary eye on inflation and trying to balance their actions accordingly.
Absolutely. It's a delicate dance, trying to support continued economic growth while also keeping inflation in check.
Speaking of delicate dances, can we revisit that intriguing point about mortgage rates actually rising in October, even though there wasn't a Fed meeting? It really highlights how much influence those other economic factors can have on rates, even when the Fed is sitting on the sidelines.
It certainly does. The Fed doesn't operate in a vacuum, and sometimes those other market forces can be more powerful than any action the Fed takes.
It's a good reminder that we can't just focus on the Fed's actions in isolation. We need to consider the broader economic context to really understand what's driving mortgage rates. Now, I know we've been painting a somewhat gloomy picture with all this talk of rising rates, but are there any potential silver linings for borrowers in this higher for longer scenario?
That's a great question. One potential upside is that higher rates could actually lead to a more balanced and sustainable housing market over time. Think back to those days of ultra-low mortgage rates. They fueled a frenzy of buying activity, pushing prices sky high.
Yeah, it felt like everyone was jumping into the market, and those escalating prices made it incredibly tough for first-time buyers to even get a foot in the door.
Exactly. Well, these higher rates can act as a sort of pressure valve, easing some of that demand and allowing prices to stabilize. This could create a more level playing field for buyers who were previously priced out of the market.
So it's not all doom and gloom for aspiring homeowners.
Not at all. While higher rates present challenges, they can also create opportunities for a healthier, more sustainable housing market in the long run.
That's a good point. It's important to look at the bigger picture and consider the potential long-term benefits, even amidst these short-term challenges. I'm curious, what are lenders saying about all this? Did any of those articles offer insights into how they're adapting to this higher-for-longer environment?
Yes, several articles highlighted a growing trend among lenders towards providing more personalized guidance and support to borrowers in this more complex rate landscape.
So it's not just about crunching numbers and pushing paperwork anymore.
Not at all. Lenders are recognizing that borrowers need more than just a rate quote. They need advice, education, and a partner to help them navigate this increasingly intricate market.
That's encouraging. It sounds like lenders are stepping up to provide more value and build stronger relationships with their clients, which is crucial when trust and transparency are paramount. Okay, so we've covered a lot of ground here, from the Fed's latest rate cut to the implications of inflation and Treasury yields on mortgage rates, and even the potential impact on the housing market. Is there anything else we should touch on before we wrap up this deep dive?
Well, there is one more point that I found particularly thought-provoking. It had to do with the potential for innovation in the mortgage industry as a result of this higher-for-longer environment.
Oh, I'm always fascinated by new ideas and approaches. Tell me more.
Some experts are predicting that this higher rate environment could spark a shift toward more creative financing options and alternative housing models as borrowers look for ways to make homeownership more attainable.
Like what kind of options? Give us some examples.
Well, one possibility is a resurgence of rent-to-own programs where a portion of your monthly rent payments gradually builds equity in the property. It could be a more accessible path for those who aren't ready or able to secure a traditional mortgage in this higher rate environment.
I've heard of rent-to-own, but I hadn't considered its potential to become more mainstream in a higher rate world. What other innovations are being discussed?
Another interesting concept is the growth of co-housing communities, where residents share common spaces and resources to lower living expenses. It's a great way to foster a sense of community while also achieving some cost savings, particularly in areas with high housing costs.
Co-housing, that's a concept I've mostly encountered in discussions about sustainable living, but it makes sense that it could gain traction from a financial perspective as well. So it's not all doom and gloom for aspiring homeowners. It sounds like there's a lot of room for creativity and resilience in adapting to this new landscape.
Exactly. The housing market is constantly evolving, and there will always be challenges and opportunities. This higher-for-longer environment might just be the catalyst for some truly innovative approaches to make homeownership more accessible and attainable.
It's exciting to think about how this might reshape the way we approach homeownership in the years to come. So with all this talk of higher rates and potential shifts in the housing market, what's the ultimate takeaway for those of us listening?
I think the key message is don't be discouraged. Knowledge is power.
Right.
And the more you understand about these economic forces at play, the better equipped you'll be to make informed decisions that align with your personal circumstances.
That makes sense. So instead of throwing in the towel, we should arm ourselves with information and explore all the options available.
Exactly. And remember, you don't have to navigate this alone. Reach out to financial advisors, mortgage professionals, or even trusted friends and family who have experience in the housing market. A fresh perspective can make a world of difference.
That's great advice. Sometimes just talking through your concerns and questions with someone you trust can help you gain clarity and confidence. As we wrap up this deep dive into the Fed's rate cut and its impact on mortgages, let's leave our listeners with a final thought to ponder. We've explored how experts are predicting a higher-for-longer scenario for interest rates, which could lead to some intriguing changes in the housing market.
Right. And it makes you wonder, could this lead to a resurgence of seller financing or other alternative financing models as buyers and sellers seek creative ways to overcome the hurdles of these higher rates?
That's a fascinating idea. Seller financing, where the seller acts as the lender, feels like a blast from the past.
It does, but it could make a comeback as buyers find it tougher to qualify for traditional mortgages with these elevated rates. It could also give sellers a competitive edge, offering more flexible financing terms to attract buyers in a challenging market.
That's intriguing. It suggests a potential shift in how we approach financing homes, moving away from the traditional lender-centric model.
It certainly raises some interesting questions, and that's what makes following these economic trends so captivating. It's not just about numbers and data, it's about how those factors shape the way we live and interact with the world around us.
Well said. So to all our listeners out there, Keep your eyes peeled for those innovative financing options and alternative housing models. They might just be the key to unlocking your homeownership dreams in this evolving landscape.
And remember, the best way to stay ahead of the curve is to stay informed, do your research, and don't hesitate to ask questions.
That's right. We'll be here to help you navigate those twists and turns, offering insights and analysis every step of the way. Thanks for joining us on this deep dive.
It's been a pleasure, as always. Until next time.